Let me begin with a question that sounds simple, but one that has decided the fate of empires throughout history. What is money? Most people believe money is what they earn, what they save in a bank, or the paper sitting in their wallet. But after decades of watching global markets rise and fall, one truth becomes impossible to ignore. Money is not a thing, it is a mechanism, a moving part inside a vast system, a machine that quietly determines which nations rise and which nations fall, and right now that machine is under strain. We are watching a familiar historical pattern unfold, one that has repeated many times before but never in our lifetime. The long cycle of money, credit, and debt. And at the center of this cycle sits a trap that is both seductive and dangerous, the free money trap, the same mechanism that has ended every global superpower before it. To understand why China is quietly reducing its exposure to US debt, and why this matters far more than most people realize, we must first understand where the United States stands in this cycle. History is remarkably consistent. The Dutch Empire in the 1600s, the British Empire in the 1800s, and the American Empire today all followed the same path. A rising power becomes highly productive, people work harder, invent more, save more than they spend, and because of that success, the rest of the world wants to store its wealth in their currency, creating the extraordinary privilege of reserve currency status. This privilege allows a nation to borrow cheaply from the rest of the world, to print money that others willingly accept, and to live far beyond its means without immediate consequences, creating the illusion of limitless wealth. But hidden inside this privilege are the seeds of collapse. The trap begins when the dominant power starts believing its own story, becomes complacent, fights expensive wars to maintain influence, and most importantly begins spending far more than it earns, paying for that gap by borrowing and pulling savings from poorer, harder working nations. By the late 20th century, this inversion became impossible to ignore as Chinese workers earning a fraction of American wages were lending money to the United States. Poor lending to rich. A reality that felt upside down but revealed something deeper. China saved, while America consumed. For decades, the US government funded wars, social programs, and rising living standards with money it did not have by selling debt to the world, a system that felt painless and permanent, until history caught up. Because eventually debt grows so large it can never be repaid in real terms, leaving empires with a choice between painful austerity or printing. And across 500 years of history, the choice is almost always the same. They print. They create money from nothing to pay old debts, and in doing so, they quietly be their creditors by repaying them in weaker money that buys less over time. We are deep in this phase now with massive US deficits, trillions of dollars being created, and the rest of the world watching, China included, as they recognize an uncomfortable truth: US debt is a melting ice cube. To understand China's response, we must separate two systems: the financial economy and the real economy. Because in the financial economy, money can be created instantly with a few keystrokes, pushing asset prices higher and creating the illusion of prosperity, while the real economy operates under different rules, where productivity, factories, infrastructure, and skilled labor cannot be printed. When money grows faster than real output, its value inevitably falls, producing inflation and devaluation, and recognizing that we are now in the late stage of the long-term debt cycle. A stage marked by hard money giving way to paper claims, optimism turning into excess, and debt expanding faster than real assets. China understands what comes next. After 4 decades of a symbiotic relationship in which China produced, America consumed, China saved, and America borrowed, Chinese leaders now see the warning signs clearly: relentless money printing, political polarization, declining relative productivity, and the weaponization of the dollar through sanctions and asset freezes, turning what were once safe reserves into strategic liabilities. From their perspective, dollar assets are no longer neutral investments, they are potential hostages, and no rational actor keeps their life savings in a system that can be frozen overnight. So China is leaving quietly and methodically, engaging in what can only be described as a capital war, not fought with missiles but with liquidity. Diversifying away from US debt, accumulating gold that cannot be printed or sanctioned, building alternative payment systems that bypass the dollar entirely, and trading depreciating paper wealth for real assets like mines, ports, energy, and infrastructure across the developing world. This is not aggression, and it is not ideology, it is self-preservation, rooted in historical pattern recognition. Reserve currencies do not collapse slowly. They collapse suddenly. Confidence holds until it doesn't, and when creditors decide that yield no longer compensates for risk, the exit is violent, rates spike, markets shake, and central banks face their final choice: print and destroy the currency, or stop printing and destroy the economy. And history leaves little doubt which option they choose. This is the final phase of the big cycle, a silent run on the bank not by ordinary people, but by nations themselves. And if you want to understand what comes next, stop watching the noise, stop chasing headlines, and instead watch the debt, watch the printing, and most importantly watch who is quietly leaving, because in the end, this is not politics, it is mechanics. And the mechanics always win.